What's good, everybody? Welcome back to the B23 Financial Academy. We hope all of our videos have found you well thus far. In this video, we will cover another important aspect of the Forex market, that being what Forex brokers don't want you to know. In the previous video, we outlined risk management, what it is, and how to apply it in terms of a trading system. We made an example using support and resistance as a trading system, how risk management applies there. We also made an example using a moving average system that we use in the academy and detailed how risk management applies to that as well. So feel free to go back to that video to catch up if you're new. If you're not, let's carry on with Tier 3's video, which will be what Forex brokers don't want you to know. So right off the bat, there's something that you need to note down. It's very important. Number one, sorry about that. Forex brokers can see what you see. First of all, Forex brokers can see what you see. The very same thing or the very same chart that you see here, your broker sees that as well. Depending on the type of broker you have, your chart may be different compared to the actual markets. I'll explain that later on in the video. But number one, they can see what you see. For example, if you put a horizontal line here or your support line there, maybe your resistance line somewhere there. Let me just move this below. Everything I'm doing here, the broker can see. So it kind of gives them an idea as to what trading style you use and how they can manipulate you if your broker is that kind, because there's different examples of different types of brokers. We have ECN brokers, standard operating brokers, or straight through processing brokers, and then we have market makers. Market makers are not a good broker to have because they take the opposite side of your trade. So when you buy, they sell. When you make money, they lose money. And when they lose money, you make money. So that's not a good relationship to have in any business sense. It's advisable to either have an SCP broker or an ECN broker, but they also can see what you see. But then the manipulation is not as prevalent compared to market makers. So let's make an example using the excuse me excuse me using the moving average trading system we did in video 4. Let me just add everything here. Excuse me. All right. Using this as an example, let me just switch time frames. Okay. So say now your broker knows that you use this trading system and it's profitable for you. What they sometimes do is, or what they can do is, since we've agreed in the previous video that whenever these two moving averages cross the turquoise moving average from above, it's a sell signal, like so. These two crossed the 36 moving average, so this would be regarded as a sell signal. What your broker might do is they might give you this signal, and then once you sell, so let's say you sold at that level precisely, okay, let's say you've sold at this level precisely, the moving averages have intercepted, you sell, but then what the broker would then do is they would manipulate the candlestick or candlesticks afterwards to make this seem like a false signal. This doesn't happen when you first start out on your trading journey, but once you start getting profitable, your broker uses many different types of tricks to kind of trick you into thinking your trading system does not work. So that's one way they can do it. Another way, let me just do, okay, let me not delete that. Something else that they might do is, let's say we're trading supports and resistance, right? Right here, this would be regarded as a resistance area. And keep in mind, they can still see what you see. So let's say you want to sell at this point, at this price level. Sell, you want to sell here, and your stop loss usually is around this level. So many people know that we sell at resistance and our stop loss is above that resistance. So these X's represent stop losses or orders by the millions. You can think of them as, okay, brokers think of this as liquidity. We think of them as stop losses. So let me just do this. And just get this here. Right. So say now your broker can see that there are many stop losses above this resistance area. So what they tend to do is they drive price up, 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 up to take out all of these stop losses that are here. Once they're done taking them out, then they drop, because all of this is free money waiting to be taken. If you're a broker, there's no way you would just let go of all of this money that you see here. Remember, every trade or every order that you do, your broker can see, whether you buy instantly, whether you have a sell stop, buy limit, sell limits, stop loss, they can see everything. So if there's a lot of stop losses above or below a certain area, your broker can see that. So you need to be wise in how you trade. I'll give you a tip towards the end of the video, but that was point one. Your broker can see what you see. And then let me just do this to kind of make things quicker. And then we'll go to the second point. Point two. Point two, your broker wants you to trade more frequently. Your broker wants you to trade frequently. Why? Because there's a higher probability of you blowing your account, meaning more money for them. So the more you trade, or the higher frequency your trading is, the quicker you lose your money and the quicker they get their money. Because brokers know, or it's well known in the Forex world, that 90% of traders are losers or will lose their money, and then only 10% really make it into the industry. So the moment or the minute you fund your account, you're automatically put in the 90% brackets of those who lose their accounts. It's quite hard to get into the 10%, but it is possible. Usually what they do is, when you're in the 90% of traders who lose their accounts, they usually target you or they manipulate you often. So they don't really assume that you're gonna make it. So they want you, or let me just correct this. They want So they want you to trade frequently. Most people just enter Forex without any knowledge or know-how of what they are doing. And that's what brokers want. They don't want you to, okay, some brokers actually offer seminars or signals or educational tools to help you make money. But then some of them do the same thing with the intention of making you blow your account. They entice you to trade so you can just donate money to them. That's point number 2. They want you to trade frequently. Excuse me. Point 3. 3. They widen the spread around 11 p.m. South African time. I explained in the previous videos that we are based in South Africa, so the time that I've typed here will be different according to your country or your time zone. But around this time, actually, they tend to widen their spread. So say now throughout the day, the spread was like this. Maybe this would be, let's say, excuse me, 8 pips. The spread here would be 8 pips. And then around this time, the spread then widens. You might get something like this. It usually lasts an hour in between when the spread has widened and when it goes back to normal. So you might have something like that. And I'll explain where it tends to kill people, myself included at the time. So this is what usually happens around 11 p.m. So say now, let me just get this back. We'll come back here. So say now, okay, here we have a support level, right? This is a support level. Great. So you buy here, or you've bought at that level. So you've bought here and then price has moved up. However, it's moved up. You are in profits, right? Price, the current price is somewhere here. For example, current price is somewhere here. The spread looks something like that from where you bought. This is the spread. This is where you bought. This is the spread. You're in profits. Price is currently above the price level you've bought at. And then you're happy. Your stop loss is maybe somewhere here, right? You're happy. Price is away from your stop loss. You're just happy that your trade played out. And then 11 p.m. hits. What then happens? The spread widens. So around there. So you're still in profit, but then the spread is wider. So when it moves, there's a higher probability of it hitting a stop loss, even though you've been in profits for almost the entire day. And it tends to just widen. Sorry about that. It tends to widen and widen and widen and widen and widen until you get stopped out. Then an hour later, it goes back to the usual spread. You come back thinking you're in profits, when in reality they've hit your stop loss and then they continue moving upwards. This is very common, it's very frequent, not many people know this. So it's great information to have. I only found out about this, I think, a year ago, and it's greatly affected and changed the way I approach the market now. So those are basically the three things that brokers don't want you to know, the ones that I'd say or we'd say are the most important. If you've learned anything of value, please leave a like on the video. Subscribe if you're new. Okay, I won't be signing out just yet. I just remembered we have a tip for you. If you're scared or if you don't want your brokers to see what you're doing, you can alternatively visit TradingView. It's not really similar to MetaTrader 4. We mostly use it for analyses or analytical purposes. So let me just show you how that looks like. I'm going to switch over there now. Let me see if I can refresh this. Reload. All right. So this is what TradingView looks like. It basically gives you the market as is. Brokers tend to have their versions of the market. It's not really that different, but there are slight variations. With TradingView, it gives you the market as is. So what you can do is you can analyze on TradingView, but then execute your trades on MetaTrader 4 on whichever broker you choose. So that's the tip for today. Like I said, if you've learned anything of value, please leave a like on the video, subscribe if you're new. It's been Mr. Billionaire 23 signing out.